Hey guys, in this video, I'm going to walk you through the exact system that is used by top 5% of the investors, top 5% of the buyers agent, investor groups, absolutely the cream of property investment industry on how they choose the market, how they choose suburbs, and how they choose that one unicorn property that is fit for your portfolio. A lot of YouTubers and buyers agents charge like 2 grand, 5 grand, or even 7 grand for a course like this. And what I've done is in the next few minutes, I've just condensed that entire sort of secret weapon that industry uses into a small, easy to understand YouTube video and a small, easy to follow through an Excel template that you can get access to after the end of the video. So let's jump in. Firstly, most investors think investing about picking the right suburb or finding the right property. But the truth is, the top 1% of investors don't just pick suburbs. They use systems. They eliminate markets. They filter deals using a structured, data-driven framework. They don't go straight to suburb or straight to property. They use a systematic filtering system so that they can eliminate the garbage, and whatever is left out is the key cream that they can use and analyze different ways and choose that perfect property or market. This is why they consistently outperform the average investors, even in the same cities, even in the same market phase. Today, I'm going to show you the exact method that we use at Heaps Good Homes to pick best performing markets. The same method we use to protect investors from dud locations, from deals that look good on paper but destroys your portfolio. We call this system the golden tap method. I'm going to walk you through in detail in the next few minutes on what this golden tap method is. But for now, just look at this picture. Remember in your head, a golden tap with 3 different filters. So TAP. We'll come to that very soon. Now, secondly, I want to stress on the real problem that exists in the marketplace. So problem number 1, you have no idea who or what to trust. YouTube, Google, agents, data analysts, they all contradict each other. Everyone's got an opinion, everyone's got a little framework, and everyone's got this data that they kind of use as a sales pitch. And it's very, very hard for an average investor to trust someone when everyone is telling a different story. Problem number 2, fear of buying in the wrong market. What if I pick the wrong city, wrong suburb, wrong street, or wrong time? This is the common feeling that most investors have. Problem number 3, analysis paralysis. I believe this is the biggest disease in property investing. People research for 3 to 6 to 18 months and still can't act. Problem number 4, fear of buying at the peak. They wait too long, then the market moves, then it feels too late, and the cycle repeats. I have seen countless investors, they're buying in the wrong location, following the hype, end up buying in the peak, and there's a correction on stagnation for next 3 to 4 years. That kills the dreams, that kills your portfolio. Problem number 5, fear of vacancy plus cash flow collapse. This is the biggest one. Imagine if your property, you're not able to find tenants. That is the biggest nightmare of every property investor. Problem number 6, hidden risks they're not trained to detect. Flood overlay, bushfire, noise, power line, slope, easement, overdevelopment risk, infrastructure stagnation. One hidden factor can ruin an otherwise good deal. So it's very important to have a very strong due diligence framework. And this is one of the most common reasons why people make 6-figure mistakes in property investing. Problem number 7, no system. Most investors make a 700 to 1.2 million decision based on a video they saw, a friend bought there, the agent said it will grow, or buyer's agent recommended it. That's not investing, it's guessing. And without a system in place, I believe most of the decisions are gonna be a very risky decision of your life. And I highly recommend you have a little framework and model a system for every decision that you make so that you're not spooked by any buyer's agents out there. Now, the golden tap method solves this by replacing guessing with filter. So golden tap method, like I said before, it's a little golden tap which has 3 attached filters. So this is how I visualize the framework. Now, every filter has a name. So this is filter T, which stands for townships, filter A, which stands for areas, and filter P, which stands for properties. Now, how it works is step 1, in this filter, you filter out all the townships that do not fit your strategy, your criteria, the supply and demand factors, and all the different principles that we have for that particular filter. So that means, let's say if there are 200 townships in the country, you're eliminating the 80. And so you're only focused on 20 because the remaining 180 is either a dud investment or dud township, or it doesn't fit your criteria, your goal, and your situation and your circumstances. So filtering the township does the 80% of the work, because if you bought in the right township, that means 80% of the work is done, because the capital growth is going to be very much at the township level. And for the next 3 to 5 years window, you're going to do pretty well, even if you bought one of the data suburbs or property. So that's little leverage you can get by choosing the right township. Second is area. So area is where you choose the suburbs. So not really so much choosing, but you eliminate all the suburbs that do not fit the criteria. And then you move on to property. So this is more like a due diligence sort of step, where you remove all the properties that do not fit your due diligence criteria, do not fit the cash flow goals, do not fit your strategy and goals that you're trying to achieve. The outcome of the tap is going to be a smaller slice of Australia, which aligns to your goals, situation, circumstances, and it is set for capital growth and a very good cash flow. So that's the reason why I've got this TAP framework, TAP, so it's easier to understand, and it's very important to go top to bottom, so it's easier to make systematic decisions. Now, look, only 3 things matters in property investing: where to buy, what to buy, when to buy. And the golden tap answers all 3 with precision. Now, let's dive into the filter T, which is townships. So what I'll do next is I've created this spreadsheet that is much easier to track and have a little framework defined. So it's got 3 different tabs. So T filter tab, A filter tab, and P filter tab. So every tab has a little principles. So these are the principles, and then every principle has some matrix, and then we have a little criteria, thresholds, and the favorable trends for each of these data points. So this way we can eliminate the markets or townships that do not tick the boxes in a criteria. So let's go through these principles, right? So principles are very important and much more important than the data matrix, right? Because data matrix can change, but principle essentially remains the same. So principle number 1 to filter the townships is money is where people move. Now, this is a very important principle, because if people are not moving in your township, then it could do well for short term, but the long-term fundamentals are not there, because money is where people move. So Queensland and WA has done tremendously well, and that's because of the massive migration. If people wouldn't have moved there, you're saying that would have grown so much? Impossible, right? So that is very important metrics. Money is where people move. So what we look at the matrix for this principle is the minimum population should be greater than 50. So the township is more concrete and self-sustaining. We don't want to focus on the tiny little township that has a risk of the volatility in the market because of this small sample size. Second is population growth momentum from recent past. So we should see the recent population growth in that township should be more than 1.5%. This kind of depends on what's the national average is. But for now, when I'm recording the video, it's December 2025. It's 1.5 as a threshold. Now, population growth rate and forecast by ABS should be higher than 1.5% as well. So once we take all these criteria, we know that the township is where we could see some money, because people are moving there. If this trends are favorable and increasing, then definitely that principle ticks the boxes. Second principle is opportunities arise when supply and demand is imbalanced due to inefficiencies. Australia is a very inefficient market. So it's not like a stock market, right? Property markets can be inefficient because let's say there's oversupply, and then the property market is stagnant, so developer stops doing development. And then the shortage arrives, the supply and demand is imbalanced, there's more demand than the supply, but the developers will take time to build the supply, and that could take 3 to 5 years. So that's the reason why property cycles go in 3 to 6 years window. And we have to be very smart in opportunities by seeing the data on what window the market is right now. So the data matrix we use for that is days on market, stock on market, inventory levels, and building approvals. So all these data is very easy to access in this lucky country, Australia. So what we have a little threshold is days on the market for warm spot should be less than 90 days. Hotspot should be less than 60 days. And the trend should be going down. So once we have these things, then we know that this pressure is building up. So days on market is basically how long the property takes to sell in the market. Stock on market is what percentage of properties are available on the market. So let's say suburb has 100 property. So that means only 2.5 property should be on the market in a warm spot, 1.5 in a hot spot. The threshold could change depending on the market conditions, because a lot of times where the interest rates are up and down or the overall economics of the country is very different, the thresholds can change. But this is what we have right now for 2025 December. It's like second last thing we use is inventory levels. How many months of inventory is available in the market? So we got thresholds of 3 months and 2 months, depending on warm and hot spot. The reason I have two categories for warm spot and hot spot is because now hot spot could be something that's already booming. There's already massive demand. So we want to set the thresholds more favorably to us, because there's always a risk of buying at the peak. So we want to be more conservative, and it should also align to your goals, because you need that quick equity. So that's why we have a little stricter criteria. For warm spot, we are okay to be a little lenient, because what we are trying to do in the warm spot is we're trying to get into the market before it booms. So that is where the fundamentals are a little different, and so are the thresholds. Lastly, building approvals, we want less than 4%. So now, building approvals are usually at the townships level. A lot of people track building approvals at suburb level, which is a very pathetic thing to do. But we want to make sure the building approvals are not massive, so there's not much of supply coming in the market, which can impact or absorb all of the demand. So that's how the inefficiencies are tracked. And that's where we believe opportunities arise when supply and demand is imbalanced due to inefficiency. So we're just trying to gauge using these metrics. This is number 3. Buy if people truly need it. So basically, since you're an investor and you're building an investment property or you're buying an investment property, you are doing this for tenants. So buy there if tenants truly need it. So that's where, if the tenants don't need it, there's ample investment properties already. Just stay away from the township, because there's no way you will win, because it's not about just capital growth. It's also about cash flow. Cash flow is garbage because of ample oversupply of rental properties. I would stay clear. So that's where we track that using vacancy rates. So if the vacancy in a hotspot should be less than 3, warm spot, and then hotspot at 1.5, and it should be trending down. So these is a very important principle that you have to keep in mind before choosing the township. Next, strong local economy indicates stability and strength. We need to make sure the economy is very strong. Unemployment rate, industry is diversified, infrastructure spending is pretty good, because these are the big macro factors that drives people moving to that country, that drives the salaries and wages of the township, and that drives the property market growth as well. Next, stay cautious at market peaks. What seems like the summit could be the edge of a cliff. Very important principle. Because if a lot of people say it's hotspot, they've been thinking, and they get into the market when it's extremely at the peak or just before stagnation period, that's where the dreams are killed. That's where the property portfolios are killed. And that's a very, very important decision in your property investing. So what we use is, it's very hard to judge and figure out though, but we can use some indicators, right? So if price change in the 3 years is more than 60%, that means so much growth has already happened. So you have to be a little careful. 10-year growth should be less than 8%, because if the market has been booming for 10 years straight, mate, there's got to be some correction or stagnation, right? Because a market cannot keep growing at 8% or more or 10% or more for forever, because wages don't catch up, So that's where we have to be a little careful once this happens. And also we have to look at the statistical growth cycle indicators. So that is where a little bit of regression modeling and statistical modeling that we do. So just to figure out if the market is not approaching peak. Now, the next principle is the most important principle. It's called your strategy shapes your path. So this is very, very important. Now, obviously, not every market is same for everyone, right? Everyone's different. Everyone's got different investment horizon, how long you're going to invest, 3 years, 5 years, 20 years. Everyone's got different budget. Land tax optimization. So let's say if you're bought in some states already, like Queensland, you don't want to continue buying in Queensland and pay those ridiculous land tax. You have to diversify, because land tax is a state tax. If you buy in different locations, you can optimize your land tax. And then also diversification. If you put all your eggs in one basket, that's the investment 101. Avoid. So we want to make sure it's diversified. So your townships change based on a strategy as well. So cash flow target. Obviously, if you're aiming high yield, the certain townships you will avoid. And then equity extraction, how quickly you want to extract equity. If you want equity in the next year, you want to buy in hot market. If you want to extract equity 3 years down the line, then you could buy in the warm market. So that changes your equation as well. And finally, risk profile. If you have high risk profile, you can try to gamble in places like Darwin for short term or regional areas. So the risk profile also dictates what your township is. People think, oh, a township is all about growth and cash flow, but no, township is also about your strategy. If it doesn't fit your strategy, we remove that as part of the first step, which is the T filter. So that was all about the township filter. Now, the next, what I'm going to go through is all the principles of the filter A. Filter A stands for areas, basically eliminating or filtering out all the suburbs that do not take the principles or criteria that we have at Heaps Good Homes. So let's go through the filters one by one. First one is if locals can't afford it, you can't afford it. So remember, this is where we're doing the suburb level analysis, and we're looking at the affordability matrix for this one. So if people living in that suburb, the owner occupier, if they can't afford to buy there, then you can't afford to buy there, even though you're rich, but don't buy if the suburb is already too expensive for locals. So we got a threshold of 40 years. So if locals take more than 40 years to pay off their home loan in that suburb, we avoid. Second principle to identify good suburbs is beware of greedy competition. So that's renter to owner ratio. So basically, if there are more than 40% of investment properties in a suburb, we tend to avoid that unless there is a very specific reasoning to still go forward. Because we don't want a lot of investment competition, because once the investor market fades, then a lot of properties can come back to market. So number 3 is opportunities arise when supply and demand is imbalanced. So the similar principle is township, but we have to beware of statistical insignificance, because at suburb level, the data might not be enough. So let's say there's only 10, 20 properties getting sold in the suburb. That's not enough to conclude the supply and demand matrix. So we have to be a little careful, but we can use the matrix such as days on market and stock on market. We are not looking at building approvals at suburb level, because I believe if it's a new suburb, then the building approval percentage will be higher, but that doesn't mean that the area is gonna not perform better, because supply in that suburb is not the enemy of just that suburb. It's the enemy of the entire area. So building approvals of the area is more important than a particular suburb. Next, we look at buy if people truly need it. We have to be a little careful that if it's a high vacancy suburb, we should avoid that. But also statistical significance we have to be aware of, because a lot of suburbs, there might be not enough rental property to conclude, or suburb might not be big enough to conclude the vacancy rate is low or high. And also, if it's a new suburb, vacancy rate is not the best metric, because a lot of new suburbs, new properties are built and they come to the market at the same time. So that's where the rental absorption rate is more important, how long it takes for rental property to be absorbed by the market rather than the vacancy, because it's not a fair metric comparison between established and new suburb because of the metric vacancy rate. But rental absorption rate, if the suburb is struggling for renters to move into the house, then we obviously stay away from the suburb. Next, stay cautious at market peaks. What seems like the summit could be the edge of a cliff. It's a similar sort of principle as what we saw in the townships filter. You want to avoid suburbs that has grown way too much so that you're not buying at the peak, and then you have to go through the stagnation. So we have to avoid that. Buy what tenant profile wants. So profiles could be like families, young professionals, students, older demographic. So based on the target profile, let's say you're building a co-living house, you're targeting young professionals and students. You have to look at what are the factors that they see in the area. If you're targeting families, then you have to see what are the factors a family need. So it's a bit of qualitative analysis rather than statistical. So anything that's proximity to employment house, proximity to schools, proximity to transport, shopping, local sports facility, hospital, university. So they, based on your profile of tenants, it's a little bonus if you have these other factors as well. But like I said, the biggest ones are supply and demand and all these previous principles, but this is also good quality to have on top of the other ones. And lastly, the biggest one, your strategy and brief shapes your path. So budget, your cash flow target, and your risk profile. So these are the 3 metrics that we use to say if this suburb is actually fit your profile. Because if, let's say, you're targeting high yield and a particular suburb doesn't offer that, then you have to eliminate that. or budget is another one used to eliminate suburbs. And risk profile as well. Some suburbs are a little bit risky. Let's say they fall under a flood overlay, but then with the right mitigation strategy of the right insurance premium, etc., you can have a good sort of mechanism to choose the right suburb. So that sums up the filter number 2, which is filter A. A stands for area. Now let's move to filter P. P stands for property. Now, this sort of filter is all about due diligence, right? So you can see everything over here. You look at the yield of the property. Is it desirable to tenants today and future? Does it fit your strategy? Buy and hold, flip, renovate, whatever strategy you're trying to do. Is it good value? Look at valuations. Building and pest inspections done and comes clean. Check product flood maps, check bushfire, zoning codes and development potential if strategy requires that, presence of power lines, any worrying easement on title plan, contract clauses, sunset clause if you're building new escalations, anything of that sort, sloping land and site cost, noise sources, freeways, train lines, title type, torrent startup, company, developer, builder reputation, NBN fiber, internet availability, planning overlays, public housing percentage, build time frames, liquidity damage clause, soil reactivity classification, council rates plus water charge, aircraft flight path overlay, drainage easements, water logging, heritage register listing, parking availability plus restrictions, especially if you're in co-living, sales history and ownership turnover, proposed zoning amendments. So these are depending on the property, new or established, or what property type you're buying. We got a little checklist which is done at the property level. So every property that you choose is like a unicorn deal. And this checklist alone can save you 6 figures because a lot of bad decisions happen at property level. They choose the good market because they're following some good advice from right people. They choose the good suburb as well, but they end up choosing the wrong property, and that could cost you 6 figures. So now these are the 3 filters. We saw the filter T, which was the townships, and then we saw the filter A, which was for areas and suburbs, and then we saw the criteria for filter P. Now, once you go through these filters, you are on God mode. It's very hard to make bad decisions because you have a framework, you have a system, and it is practically impossible to make those 6-figure mistakes. And that's why a lot of people are all about following the hype, following what the buzzwords, buzz locations. But if you have a solid framework in your mind and your process, then you're unbreakable. And that's why we at Heaps Good Homes, we preach everyone, single one, to have a little framework. Now, your framework could be a little different than what I have here, but at least have a little framework. And I believe TAP is one of the most easiest to understand framework. Now let's talk about why Golden Tap works. A lot of people, a lot of clients have said, like, why do we need such a framework? Just buy me a good properties in my suburb or next to my suburb. That's the kind of little psychology and mindset a lot of people have. Firstly, I want to say, look, property markets move top down, not bottom up. Most investors start with the property, they scroll listings, fall in love with the photos, and hope the suburb performs. But markets don't move that way. Property market moves top down. Townships move first, then areas within the townships, then specific properties within those areas. Golden Tap forces you to respect that order. If the township is weak, no point of renovation, styling, or yield engineering will save the deal. Second, it filters out noise before emotions gets involved. The biggest enemy of risk isn't returns, it's noise. Noise looks like media headlines, TikTok suburb tips, WhatsApp groups, friends' opinion, agents pushing stock. Golden Tap replaces opinions with filters. Each filter removes bias, emotion, and guesswork. By the time you reach the property stage, you're no longer choosing, you're qualifying. Number 3, it mirrors how top 1% investors actually think. Top investors don't ask, is it a good property? They ask, does it fit my system? Golden Tap forces discipline, creates repeatability, removes randomness. Any repeatable systems always outperform one-off wins. That's why institutions, developers, and elite buyers agencies always use frameworks, not instincts. Number 4, it reduces risk before you chase returns. Most investors chase returns first and then try to manage risk later. Golden Tap does the opposite. Risk is filtered at the township level. Risk is further reduced at the area level. Risk is controlled at the property level. When the risk is managed early, returns become more predictable, and that's how portfolios scale safely. Number five, it protects you from market cycles and hype. Every market has cycles: boom, hype, overcrowding, flat periods. Golden Tap works in rising markets, flat markets, uncertain markets because it focuses on demand fundamentals, economic drivers, human behavior, and long term population movement. Hype fades, fundamentals compound. Number six, it helps you say no to 95% of deals. The biggest advantage elite investors have is not what they buy, it's what they reject. Golden Tap gives you clear rejection criteria, confidence to walk away, speed in decision making. If a deal doesn't pass all three filters, it's out. That discipline alone puts you ahead of 95% of the investors. Number seven, it turns luck into process. Most people think great property deals are about luck. They're not. Luck is what people call a system they don't understand. Golden Tap makes outcomes predictable, makes performance repeatable, makes success scalable. That's why unicorn deals aren't rare for us. They are a byproduct of process. So lastly, I want to end this presentation by saying unicorn deals are not luck. They are a result of a system. It's very, very important to have a system and framework in your property investing journey, because without that, you're just guessing. We don't want to be guessing. We want to be filtering. So look, if you like the presentation, if you like an approach to property investing, you can book a call with us and we can talk and learn a little bit about you and see how we can implement Golden Tap in your strategy. Or if you're already speaking to any one of your consultants at Heaps Good Homes, you can have a chat to them and say, look, I want to discuss more about Golden Tap and all the services that you offer at that. So I'll be very keen to speak to you guys and also be a proud partner in your property investing success. Thank you.